So I'm very happy to be here, and I wanted to say it's about almost 6 years since George began it, and it's nice to see Carol here too, because Carol, with her support, and with George, of course, we were able to begin this Ben Graham Chair of Value Investing. So I'd like to recognize George, first of all, and Carol's support. So let's give them a nice hand. I went to this school 36 years ago. 36, I was like you, all of you here, and it is really nice to be here. And I remember attending classes very similar to this, and my classmates, and I guess myself, always wondered, how could you do well? And so it reminds me of the story of this young person like you, who goes to this old guy and says, you've made a lot of money, sir. How did you make this money? And the old guy says, you had done well, so he fingered his vested suit, and he said, it all began in 1932, son, bottom of the Depression. I bought an apple for 5 cents, polished it up, and at the end of the day, I was able to sell it for 10 cents. And then I went the next day, bought another apple, polished it up. 5 o'clock in the evening, was able to sell it for 10 cents. And in a month, I had $1.37. So the young guy said, I guess that's how you made your fortune. You just continue to do that. He said, hell no. A little later, my wife's father passed away, and we inherited $2 million. So much for coming from scratch, okay? Take all that with a pinch of salt. Now, I wanted to say, first of all, this school this class that George has established, as you know, a little more than 5 years, about 6 years now, going to be 6 years. It's number one in Canada, and we're really excited about that. And I think it's fair to say it's par with Columbia, and now expanding worldwide. And we're working with George to do that. So I really do think, George, you've done an outstanding job. I had a little bit of a bite with George, and it reminded me that we did not choose a professor for 3 or 4 years. We wanted the right professor to teach you all, someone who had a value perspective, and boy, did we luck out with George. Problem with George, of course, was his last name, was a little bit of a tongue twister. It took us some time to figure it out. But let's recognize George one more time. He's just a fabulous professor. So what I wanted to do for you today, I wanted to answer your question. What I wanted to do, I wanted to tailor this to what you want. So I wanted to talk a little about value investing, what a wonderful field it is. Then I wanted to talk to you about business, because I was fortunate enough to take control of a small little company at the time called, it used to be called Markel Financial, it's called Fairfax now. Then I wanted to tell you about the guiding principles we used, and those principles apply to any business, and talk a little about that, and then open it up for questions. And I'm really happy to answer any and every question that you have, whatever question comes to you, okay? Because I've come here to talk about things that are useful to you. But I thought I'd preface it by talking a little about Ben Graham. So one of the reasons we put this course is when I went to school in 72 to 74, Ben Graham was not mentioned in this fabulous University of Western Ontario Business School at the time, not the Ivey Business School. And it was all alphas and betas and efficient market and that kind of thing. So when I got my first job, I was telling George I was going to tell you how I got my first job. I sat like you guys. We had the alphabetically, and so the Watsa, next to me was a fellow by the name of Bill Vipont. Really, really smart guy, good guy. Every job I went for, he was there, and he'd get the job. So this particular job, Confederation Life Investment Analyst, there were 4 people selected for the second interview. I was one. And I got the job. And you might be surprised as to why I got the job. The other 3 didn't show up. I was the only, it was a life insurance company. I showed up and I got the job. And, life is so coincidental, and I had the great fortune to be taught under a gentleman by the name of John Watson, who's trained all sorts of people in Bay Street on value investing. And so he put a book called Security Analysis, and he, an intelligent investor. And it's one of those things that I read the book, and immediately it appealed to me. And it's one, over the years, I've met all sorts of value investors. It's either you like it and it hits you right at day one, or it doesn't. And for me, it did. And I was so excited that about Ben Graham that I asked my wife, and I think some of you may have known, I asked my wife, I said, if we have a son, I want to name him Ben. And she agreed, and we did have a son, and his name is Ben, and he's in value investing also. So it is, Ben Graham. So very simply, Ben differentiated between investment and speculation. His whole thing was to differentiate between investments and speculation. And it was, he tried to keep it simple. Remember, he said, stocks is not just a piece of paper. You're owning a piece of a business. Never forget that you're owning a part of a business. So the fact that stock prices go up and down, don't think of that. Think of the fact that you're owning a piece of the business. On the other side, stock prices go up and down. And the market goes, sometimes it's very excited, and sometimes it's very pessimistic. And it goes through those emotions of fear and greed. And you have a huge opportunity to take advantage of the market. When the market is very high, gives you an opportunity to sell. We've done it for 35 years. And when it's low, then you have an opportunity to buy. And I'll give you some examples of that. But most important principle he taught us was the margin of safety. That whatever you buy, try to buy $1 for 50 cents. Try to figure out what a company's worth and try to buy it for 50 cents. And there's all sorts of formulas. George will teach you some, but you'll have to have flexibility. John Templeton said always you have to have flexibility. There's no magic formula in terms of how you find out what a company's worth. But once you find out what a company's worth, you have to have patience to buy it at a price lower. So we used to use this margin of safety, and I used it in our book. We just celebrated 25 years. Roman bridges have met the test of time. They last forever. You go to Europe and go to different places, even in the UK, and you'll see these remnants of these bridges. The reason they've lasted so long is the guy who designed it, they put him underneath the bridge before any traffic went on top. So he made sure there was a margin of safety. There was a lot of safety before he let it, and that's why they've lasted so long. So in our company and in companies that you look at, you always have to look at a margin of safety. Now, so Sir John Templeton, I was very privileged to know him for 30 years. He was our mentor in our company. Lots of people I work with. He explained it like this. Like here at university, you've got engineers, and you've got all sorts of disciplines. So value investing is similar to this. You take 10 chemical engineers, and you tell them to design a refinery. And it's not exaggeration that if you take their average design, you'll get a good refinery. And if you did a bridge and you did civil engineering or you did any human activity, if you took the consensus, you'd get a good whatever you were designing. But in the investment business, because it's a discounting mechanism, if you take 10 oil analysts and you ask them to recommend their industry, and if they're all positive on oil, then it's likely that if you buy oil stocks, you'll be very disappointed because their opinions are already in the stock market. One person changes his mind and stock prices come down. So all what you do in human activity in terms of going with the consensus in the stock market does not work. Works just the opposite. If you follow the crowd, Mr. Templeton would say, you'd get the results of the crowd. So today, some examples, just some examples, and then we'll leave it for value investing. But Nortel, Northern Telecom, used to be 40% of the Toronto Stock Exchange in 99-2000. It was selling at some huge price-earnings ratios, right? You should never have bought it, but 40% of the index, it was tough not to own Northern Telecom. We didn't, but many other managers felt they had to own it. Well, 40% of the index then cut to 5 or 6 years later. They went through some problems. Well, they had some bonds. They had about $4 billion of cash on the balance sheet, and they had $4 billion worth of bonds. And those bonds, about 2 years, a little more than 2 years ago, were selling at 40 cents on the dollar. And you could buy those bonds at 40 cents on the dollar with cash and bonds equal. And you could say that you didn't like the stock was at $1. You didn't like the bonds at 100 cents on the dollar, but at 40 cents on the dollar, you were getting $1 for 50 cents. And you could buy it, recognizing that if it went bankrupt, you'd get your money back. We did that twice, 40 cents on the dollar, it went up to 100 cents on the dollar. The next time, a few years later, it came down to 20 cents on the dollar, very close to bankruptcy. But when you went and looked at it, you felt you could get 40 or 50 cents. So Ben Graham said, there's a prize at 100 cents on the dollar, 90 cents, 80 cents, 70 cents, 60. As you go down, there'll be a prize, and it might be 8 cents, where you get $1 for 50 cents. What you pay makes a huge difference in relationship to what you get. So it's always sensitive. Switch to Johnson & Johnson. Johnson & Johnson, fabulous company. We really like it. We got a big position in it. But 6-7 years ago, Johnson & Johnson was selling at 25 to 30 times earnings. It used to sell at a little higher than that. So Johnson & Johnson, say, was $60 a share in 2002, 2003, earned, say, $2.25. Today, same price, the earnings are $4.50 to $5. So the price-earnings ratio has gone from 25 times to about 12 times, right? And people look at Johnson & Johnson at 60, say it hasn't done a thing, it's not worth buying. Now, if you look back in the track record of Johnson & Johnson, there'll be like maybe 5 times you've got a price-earnings ratio of 12 times in about 60 years. Rarely sold. It's such a quality company, lots of cash, huge market shares all over the world. But if you think for a second, can this experience be repeated? Meaning 2.25 to 4.5, price-earnings ratio from 25 times to 12. For the next 5 or 6 or 7 years, to have that same experience, you'll have to have the price-earnings ratio go from 12 times to 6. And it might happen, but highly unlikely. So if you buy it, you will likely get the earnings growth of this company, which has been in the 10 to 15% area for the next 5, 6, 7 years. But if by chance it goes back to the price-earnings ratios that it's been selling at over the years, then of course you get the double whammy. It goes from 12 to 24, 25. Then of course you get a price earnings plus the earnings. And that's when the cash register really sings, right? You get the price earnings and the earnings going in your favor. But most people don't like Johnson & Johnson or Coca-Cola or any of these big companies because in the last 5, 6 years they haven't done well. So they extrapolate that into the future. But here's one thing that I thought you'd be interested in. It shocked me. You know, New York City is, of course, perhaps one of the centers of commerce for the last 100 years. So you think back and you say, real estate is most of you would say, can't lose with real estate. You buy in a good location and keep it for the long term, you'll make money. So here's a story about real estate that I was quite surprised. There's a street in New York called Park Avenue, one of the best streets. In 1930s, the Rockefellers' son, they're moving from big houses to apartments, big apartments. So there's a building called 740 Park Avenue. And the top apartment house, 16,000 square feet, Mr. Rockefeller Jr., Rockefeller, the famous Rockefeller's son, he bought that apartment, built it, bought it, and it cost about approximately $250,000 in the 1930s. Took a little time to get the property, build it, $250,000. He died, I think, in 1960, 61, something like that. His widow owned it, and then she died in 1971. So you're talking the better part of 40 years, right? His widow, sold that house, believe it or not, in New York, in one of the finest places in New York, best streets in New York, massive apartment, 60,000, for $250,000. No change over the better part of 40 years. No one would have predicted that, right? So this is what happens. Of course, since that apartment, and if you go to New York, you'll see it, it's gone to $6 million in 2000. And if you knew this history, you might wonder what happens to the fellow who bought the apartment at $6 million. Right? He bought it in 2000. Now, I just came from China. We have a business in China, and it just intrigues me. Speculation is always there, and you see it all over the place. I talked about it in the last time, George, in terms of oil stocks and technology stocks and Northern Telecom and all of that. But here in China, so we're going and seeing our company. We have a 15% interest. We're trying to hustle it and increase our interest over time, and meeting a lot of people. And there's this lady and 2 or 3 people taking us around. And while chatting on the way to the airport, she says she owns 4 apartments. I said, "You own 4 apartments?" "Yeah," she says, "and the one that I live in, gone up 4 times in 4 years." I said, "Oh," and she said, "Yeah, you think that's, all my friends own at least 3 apartments. We don't think stocks is the place to go, it's apartments." And I said, if you sell, so I found out what she had. I said, "You sell that one apartment that you have," she's in her 30s, and she wasn't making a lot of money. But if she sells this apartment, she'd have $1 million US, which in China would be a lot of money, right? 1 apartment, not 4. Just sell 1. You'll have 1. So I said, "Why do you sell that? You'll have $1 million." She said, "No, I sold an apartment 2 years ago, and it doubled. There's no way I'm going to be selling any apartments." And I've seen this 50 times if I've seen it once. It was the same sort of story in the United States years ago. House prices are going up. You just have to buy it. And everybody believed it. A little of it is today prevalent, less so in Toronto. The house prices seem to have gone up, and they don't seem to want to come down. But everywhere, in the UK, in London, they used to say that. But my experience is always it does come down. It's only a question of time. And so if you're a value investor, you're looking for $1 for 50 cents, this is the type of thing you'd shy away. You wouldn't buy any apartment. So you have to go against the crowd. You have to go away from where everyone's going, reflecting the money. So for me, Ben Graham was, I a huge debt of gratitude, because Ben Graham gave us the investment philosophy of our company, Prem Watsa Investment Council. And we don't have another investment philosophy. We have just one, single-minded, value-oriented, no top-down momentum, none of that. All our guys are focused on just one thing, value, and we go wherever the values are. And it might be, right now, it might be commercial real estate, it might be Johnson & Johnson. Used to be, just plain old government bonds, be safe, prior to 2008. Of course, in 2008, it was common stock. Everything was down so significantly. Buffett, of course, Warren Buffett, taught us how to apply that philosophy, not only in investments, but in business. And I'll say a little more about that. And there was a couple of, and I'm mentioning these names so you know Ben Graham, so you'll read about him. Buffett, you know. But there's another guy who ran, one of the great money masters was a gentleman by the name of Larry Tisch, who ran a company called Lowe's. His sons are running it today. And another company called Teledyne, just one you should review sometime, run by Henry Singleton, one of the best track records over 25 years. And we learned a lot from him. But the person we really was our mentor, and we knew for 30 years, passed away at the age of 95. One good thing, by the way, George, for value investors do seem to live a long life. You know, there's Irving Kahn at 105, still investing. And so John Templeton died at 95, but John was a great mentor to us. Investments, as well as his views on spirituality. He was a wonderful spiritual man, the most humble man that I've known. And he wrote a lovely book, by the way, that's worth reading, called The Humble Approach. So he always fed. If you meet him, when you met him, he wouldn't tell you any ideas. He said, George, what do you think of? What do you like? What are your ideas? He wouldn't be telling you his. And I'd say, Mr. Templeton, like, I've come to meet you. I want to know your ideas, not mine. But that's the kind of person he was. Okay, so that's on value investing. Happy to answer any questions. Just on what does what's a business supposed to do? What makes a good business? So we faced this question 25 years ago. And we said, okay, what should a business try to accomplish? And we set on our page, one single page, which I think I have here. A page like this, it's in our annual report, guiding principles for our business. And we said anything in our company can change except these guiding principles. And so what are they? First and foremost, a company has to build shareholders' value over the long term. And you can only do it by treating your customers well, your employees well, and in our case, and many companies, investing in your communities. You do all of those things, the shareholders benefit, and you benefit in the long term. And we are our example. We are a good example of that. But Coca-Cola, there was a fellow who ran Coca-Cola, Roberto Gozzietta, the CEO of Coca-Cola for the better part of 15 years. And he was a wonderful guy. And he said, you make a profit, and then your customers are happy, and your employees are happy, and he says all our communities benefit. Our own case, 1985 when we began, the whole company, market value, $2 million. We give 1% of pre-tax every year, just a formula by formula, in all the communities we operate. Last year, $12 million, just 1% of our profits. And so you can see that we think of that as an investment in a hospital, in a university, right? Business has a responsibility to do that. You treat your customers well, you treat your employees well, and then you reinvest in the communities that you do business. Because we don't live in a vacuum. You have children, you have who will go to the hospital, who will go to, will come to university like the University of Western Ontario. We all benefited. I was saying to George, I came here, you guys, I think have to pay, I don't know, $50,000, $100,000. For me, $600 a semester. Can you believe that? And that was pretty tough too. $600 a semester. But so we do have to put money back into in all of these institutions that are so beneficial to us. Second objective was always, for any company, financially sound, both for problems that you can't see, but also to take advantage of opportunities that come by. And if you're financially sound, you can take advantage of opportunities, but also for problems. And the problems that you can see, never a problem. It's the problem that you don't see will hurt you and maybe kill you. So you have to be very, very careful about that. And our third objective was a simple one we learned from Buffett, is to disclose the negatives about your company. So business, you always have problems. You always have things that you didn't do well. You always have things that you didn't, you made a mistake. And as opposed to trying to hide it, just put it out in your report, get it out. Most important thing is you don't fool yourself because you've talked about the problems, and you have to solve them. So you've got it down there, you might as well solve them. And even in our own company, many times, we're decentralized, so our presidents would say, you don't have to wash our dirty linen. But the fact that you put it out forces you and everyone else who's there to solve it and move forward. And it's just something that, and we don't give it to we think that the guy who's running the company, the lady who's running the company, has to do that themselves. They have to write to the people who own the company, the shareholders, to tell them what happened in a simple way, what the pluses and the minuses, and you have to explain that. That's a responsibility when you run a company that you have. And we learned that ourselves. Structure. Our structure, the only thing I wanted to make there in our guiding principle, we're decentralized. So we got a very small holding company, and we have very many different companies that are run by presidents. But the big advantage of that, decentralized, you develop huge talent. It unleashes talent. Imagine if we write about $5 billion in premium today, $5 billion in revenue, if you take everything into account, $6 to $7 billion in revenue. And if it was one company, my goodness, it'd be bureaucratic. You wouldn't be able to we're split it into, say, 5, 6, 7 companies. And so these people can run it like they want, and these people can run it. And you develop huge talent. It unleashes talent. It's been my experience. So when you analyze companies and stuff, you have to worry about how are these people encouraging talent, this company that you're analyzing, and how are they unleashing talent? Unleashing the ability of people to make decisions quickly and not get bogged down in a bureaucracy. So we've been, that's been our experience. Finally, in terms of values, the biggest one is one that you all subscribe to. Honesty and integrity will never be compromised. You've got to put it right up, and we've done that. And most companies are like that. They put it right up and stick to it. We also have something that's unusual. We say we want to work with team-oriented people who get along. We think pride and arrogance, you'll recognize in your own classmates, pride and arrogance can be the expression pride goeth before a fall, can be very, very debilitating and can be a problem. So we in our company, however good you may be, but if you're proud and if you're arrogant, you don't care about anyone else, we do not want you to join our company. Very simple. We like team-oriented people, and we're very fortunate. We've got a whole bunch of people who are that way. And but we also say we don't want to succeed at the expense of families. All of you we have a different life. You got your families. You got your different interests that you have outside the work. Well, outside the workplace. So we say we don't want to succeed at the expense of our families, and we keep reminding ourselves. No guarantee, of course, about that. And finally, of course, we have a little thing saying we're working very hard. Might as well have fun in the office. So we have fun while we work. In our guiding principles, I showed it we have a company in Paris, and I showed it to them. They couldn't remember anything other than have fun at work. That's the last value that we had. So that's what I wanted to talk to you about. And then one day, after you graduate from this wonderful institution, you're going to make a lot of dough. You're going to do very well, all of you, because you're smart, you're trained well, and you're hardworking. And then when you do, perhaps you'll remember this Chinese proverb. And the proverb goes something like this. If you want happiness for an hour, take a nap. If you want happiness for a day, go fishing. If you want happiness for a year, inherit a fortune. But if you want happiness for a lifetime, go help somebody. So, my friends, I'm really happy to be with you, and I'm here to answer your questions. So, please fire away, and I'll be happy to answer your question. Yes?
What got you started?
You have to go to the mic, eh? Okay. The mic here. Come right here. Right here. You have to move a little.
Hi, my name is Arjun Gupta. I really enjoyed your talk. I guess I'm curious as to what led you to value investing. You said you started in chemical engineering. What led you to where you are? Like what drove you to start in this field?
An example of value investing, did you say? Or
No, what led you to this field?
what led me to this
Yeah,
field?
why
Yeah,
did
no,
you-
that's very good. My background is interesting. My father and mother were teachers, so I had no experience about business. That's a good question. I had no experience about business, and I was really fortunate. And I came to I did an engineering degree. And by the way, when you do engineering, and then you do a business degree, like in engineering, there's one right answer. You don't get 30.235, it's wrong. You come into business, and everyone's got a right answer. Someone's got assumptions like this. That's right. Assumptions like this is right, totally opposite. Took me forever to figure that out. But so it wasn't easy learning business and accounting and all of that. But we had a prof here at Western. His name was Fred Jones, and Dean Jones. He was the dean, like Carol, and he'd like to take one class, and I think he took it in his second year. It was a second-year course, and he'd come in, and he would have something like a brokerage report. He'd say, forget about reading your textbooks and all. Here's a report on, I remember it still, Alcan aluminum by some Wood Gundy, say, CIBC Wood Gundy. Here's it distributed to everybody. He said, let's discuss this. And here's another one for next class. And that's how you talk about, and he brought investments alive. It became, it really did become alive. And that was my first introduction to investments. And then, I must tell you, I was chatting with my wife on the way that I had two jobs when I got out. One job at 3M in London, Ontario. And you really don't know what it is you're doing, right? You got an MBA and you're saying, I need a job, I got to make a few bucks. So I got a job as a financial analyst at 3M, and I got a job in Confederation Life, as I told you, 1 out of 4. And London those days was a very, very small town. Very, very small town. So we wanted to go to a bigger city. I had Fred Jones talk about investments. That sounded pretty good. So I applied to Confederation Life. I got to tell you, that's how I got the job. But then I got introduced to security analysis by Ben Graham, and then I loved it. And so in your life, you have to keep, be nice and flexible. Life will come and hit you in an unprepared way, in an unplanned way, almost at random. And you'll see something and you'll say, that's what I want to do. I was talking about this one more before I go on to the next question. I did engineering, and I was 21 years old, and I still give this book to everyone. There was a guy, I was traveling back from where I did engineering to my home, and I was sitting down, and at night, this guy sat next to me. We were unreserved, no place to sit. It was about 8 hours in the train. So this guy sat next to me, and he says, have you read this book, Think and Grow Rich? Total stranger, Think and Grow Rich. I said, no, I never even heard of it. And he says, that's a terrific book. It's written by Napoleon Hill, and you'll enjoy it. I was 21 years old. I read that, and it's to this day, I think it's probably the best book you can give a young person like your age, and a little younger. And it talks about why people, one of the guys I was talking to, George, was looking at what makes a good value investor, right? What are the characteristics? So this one was, why do people become successful? They got wealthy parents, Are they very educated? Um, are they good athletes? What makes good? So this guy, Napoleon Hill, Andrew Carnegie, you might not know, was one of the wealthiest guys. So Andrew Carnegie, true story, hires Napoleon Hill, and he says, I am going to introduce you to the 500 most successful people in America. Presidents, actors, you name it, doctors, professors, whatever. And I want you to find out what makes them successful. And his research he puts in this book. And if you haven't read it, it's fantastic. I'd recommend you read it. For $5, you can get a book. It'd be a terrific investment. So I had read that too. But a lot of life is good fortune. That's, I happen to be a believer in, in the good Lord that blesses you. And I have to tell you, I'm blessed. Like, I look at my life, many decisions like this. But, I got married when I was 23 years old. I'd met my wife, but at 23 years old, easy for it not to work. My children, I had 3 children. You can imagine your friends, when you have a son or a daughter that might have problems, health problems and stuff. None of our kids had any health problems. So you go through a lot of these things, and you realize you had very little to do with it. And you were very fortunate. So I'm one of those. I'm just really, really fortunate and very blessed. But that's a true story. That's how I got into investments. You're very welcome. What can I answer you?
Hi. Well, I was really curious to get a little more of a story of your strategy during the last couple of years during the recession, and
Yes.
for instance, you made acquisitions in U.S. banks, Wells Fargo, and,
Right.
and others, and so it'd just be great to hear a little more about just overall what was your strategy in terms of looking for opportunities compared to previous recessions, and just to see how you went about that.
Yeah, and now you mean, or at that time?
I guess, yeah. Well, more like during the downturn, like
Now,
how you approached that.
Yeah. So just a little perspective. You know a little about what we said in the past. So we were worried about real estate in the United States. Didn't have to be a genius. You just saw it. House prices going up. People just thinking it's not going to come down. And we saw it in 03, 04, 05, long before 08, right? And then, of course, so we had a lot of our portfolio in government bonds and in cash. And then, of course, the stock market dropped by 50%, and you had Wells Fargo selling below book value. Wells Fargo is a tremendous company, and banks' book value is not a bad first measure, especially if you trust management. Management of Wells Fargo is outstanding, long history, and you could buy it below book value. So we bought it, and the Dow was maybe 9,000. The S&P was like 700. It's 1,300 today. The Dow was, I said 9,000, it's more like 6,000, 7,000, and it's now 12,000. So everything's gone up 90%, right? The yields, so what happened in late 2008, early 2009, the spreads between government bonds and corporate bonds just widened. People were so worried, and so it widened. So you were getting paid to take risk. So, of course, we took risk. We bought corporate bonds. We bought distressed debt, meaning junk bonds, huge yields, 10, 12% spreads above government, U.S. government bonds or Canadian government bonds. So, but now the spreads have come down dramatically. The markets have gone up about 80 to 100%. So today, what would you do? So today, we're a lot more nervous. We're nervous today. We think 2008, what happened in 2008, once in a while you have these things, but 2008/2009, in the insurance business, you have to protect yourself from what they consider to be a 1 in 50, 1 in 100-year event. What is that? So you take Miami. You have windstorms, and they go by category 1, 2, 3, 4. 5 is the highest windstorm you can have, a real hurricane, very powerful hurricane. If it hits Miami, it's never done that before, but if it does, it's a $100 billion loss minimum for the industry. So you, as a property casualty, like our company, we do business in the U.S., we got to think, what happens if that happens? and we want to survive. California earthquake hasn't happened for a long time. In San Francisco it did, but in Los Angeles, 8 on the Richter scale, massive damage. How are you going to survive that? So you got models, you can figure it out. So we figure it out, make sure we can survive that. The same in the investment side. We think of this, what happened in 08, 09, early 09, as a 1 in 50, 1 in 100-year event. It's a rare event. It's not like what we've had recessions in 74, 75, in the 80s, small things that came back. This one, you had about some of the biggest companies go bankrupt. You had Citibank almost bankrupt. You had Merrill Lynch gone. You had Lehman Brothers went. Bear Stearns went. I mean, you go through the list. AIG went bankrupt, saved by the government. But you had a whole ton of companies that went bankrupt. So we are thinking of 08, 09 as a 1 in 50, 1 in 100-year event. And what that means is, what events are there in the past like it? So there's 2 that come to mind. One, of course, the Depression in the 30s. And the second, many of you will read about this, is Japan. And I have been to Japan in 1987, 88, 89, and the Nikkei Dow was 40,000 at that time, 38 to 40,000. And they would say to you, if you went and met the people in Japan, they'd say, we're different. We're not like the Americans. We work together. We will protect the real estate. We won't let the stock prices go down because I buy his stock and he'll buy my stock and we'll be fine. And if you heard that, today, from today's perspective, at that time, you might have believed it. Like we were there and he said, maybe these guys, they really work well together. And that was in 1989. That's 20 years ago, 40,000, and today it's 10,000. That's 75% down in 20 years. Interest rates, long Japanese government bonds were 8%. They're now like 1%. In Japan, as in other parts of the world, you have to have, if you're a life insurance company, you have a minimum guaranteed 3 or 4%. So your life policy will give you a guarantee 3 or 4%. When that interest rate went below 1, 9 of the top 10 Japanese companies went bankrupt. Life companies. 9 of the top 10 life companies were gone because they could not match their liabilities. Right? You're giving a guarantee of 3 or 4%, there's nothing you can make to give you 3 or 4%. And stock market dropped 75%. And here's the thing that'll blow your mind. They did all sorts of spending, government spending. Government spending at the time was 50% of GNP, 50, right? Today it's 200. So it's not like they sat down and said, we can't do anything. 50% of 200, they were building bridges to nowhere, just like spending money, right? But here's the thing. The nominal gross national product, GNP, is the same today as it was 20 years ago. Like if someone had told you that in 89, 90, you would never have believed it. That the GNP would be flat, and there's 7 out of the last 11 years, there's been deflation. Cumulative deflation in the last 20 years, about 15%, meaning prices are down 15%, right? And flat GNP. Go back into the 30s. 30s, of course, you had a huge drive. The economy dropped by about 40% from 1929 to 32. And then it comes back up. But by 1940, it's still not higher than what it was in 1929, the economy, gross national product. The Dow Jones was 400 in 1929. It never hit 4, and they were talking about long-term investing. There was actually in August of 1929, there was an article saying that anyone can make money in the stock market. Just put 10% of your salary in the market, and you will make money over time. 10%, save 10%, put it in. 400 in 1929. It didn't go to 400 again till 1954, 25 years later, right? So these are exceptional time periods. And so our worry is that that's what we're going today. And the main reason is You come through 20 good years prior to 2008. You came through 20 or 30 good years in Japan prior to 1990. And you came through at least 10, 15, 20 years prior to 1929. Really good economic growth, good times, and then you accumulate too much debt, happened in both different periods, both in Japan and in the 30s, and it's now, we got a lot of debt in the system. It'll shock you if you look at the amount of debt today in the United States, if you add the individual debt, business debt, and government debt as a percentage GNP, and compared to the 1929, it's higher today than it was then. And so that's why we get worried. So your question, so we are worried about that. Markets are not, where they were 2 years ago. They've gone up 90%, lots of optimism. We like companies like Johnson & Johnson, but basically we've hedged our portfolios through the S&P 500. And for a value investor, there's always things you can find, and we do find them. But this is a time to be cautious, is how we'd put it. Just because everything has gone up. And it's this 1 in 50, 1 in 100-year event in our mind. It doesn't come often. It comes once in a while. By definition, once in 50, once in 100 is a rare event. Ben Graham, I don't know if you... Ben Graham almost went bankrupt in the 1930s. But Ben Graham wrote this, which was fascinating. I keep thinking about this all the time. If you were not bearish, if you were not worried, if you were not scared in 1925, that's 26, 27, 28, 29. 9 is the crash. If you were not scared, what he's trying to tell you is the markets were so speculative from 1925, and if you didn't recognize that, 1 in 100 chance you wouldn't have survived in the 1930s. Because, of course, the Dow Jones went from 400 in 1929 to 40. It went down 90%. And this is how it went. It went from 400 to 200, down 50%. Then it backed up to 300, and everyone said, perhaps like today, everything is fine, all well, we're ready to go, move forward. And then it comes down like a ton of bricks. It comes down by 70, 80%. There's a lovely, I shouldn't say lovely, but there's a good book for you to read called The Great Depression, A Diary. And it gives you, there's a guy who's written, who is a lawyer, young lawyer, and he's going through the Depression and he's keeping a diary. So he's not interpreting stuff. He's just telling you what's happening on that day. This is what happened and this is what happened. And fascinating to read. The Great Depression, A Diary. So we're a little nervous and worried about what's happening. But that doesn't stop us investing in stocks and bonds. But we are cautious. And in our minds, we say, what happens if things go down 50%? Can we survive it? And we're always looking at that possibility. But value investing will protect you. But as Mr. Ben Graham himself found out, he almost, because he had debt. A debt is, like George was saying, you have debt, and you can have, you might not survive. So you have to be very, very careful. But once we get more realistic and the optimism comes out, you might have terrific opportunities like you did 2 years ago.
Thank you.
Hi, Prem.
Yes.
My question's with regards to your investment in Torstar Corporation. I'm wondering if the investment was made primarily based on the strength of Harlequin and that business, or whether you believe the Metroland and Toronto Star part of the business will continue to create value going forward. And I'm wondering if your views changed at all given some of the recent things that have happened.
Yeah, Harlequin is a terrific business, as you know. You probably know this, but they operate all over the world, 100 different countries. But what, the thing that we have done over 30 years, 35 years, we are passive investors. So we don't like the idea of buying a big position, changing management, and being hostile or activist or whatever. So if we own a big chunk of Torstar, our portfolios, when we began at Fairfax, we used to have insurance company float. So when you pay a premium before we pay a claim, that float used to be about $30, $40 million. when we began. Today it's about 23 billion. So when we invest that money, 23 billion, when we invest the money, sometimes we'll have 20% of a company or 25, 30% of a company, just because of the size. But it's always friendly, and we are with management. We wouldn't buy a company with the idea that we'd take a position, get rid of management, we think it's not the right way to do it, and probably doesn't get you the returns anyway. So we go with the management, back them up, and but when you talk about the newspaper business, and you see, I think newspaper circulation has dropped significantly. Newsprint, which is the what you need to print a newspaper, that's down 50%, like from the high to where it is today, down 50%. I mean, like a few years ago, you'd laugh if someone told you that newsprint consumption, it might be 5, 6, 7 years ago, you'd laugh if someone said to you that it was down 50%, but that's what's happened. And so the newspaper business is going to be tough, and somehow they have to get paid when they go into the internet. The Wall Street Journal, you got to pay. The Financial Times and the UK, you got to pay. And over time, Torstar has to figure out how they'll get paid for their the content that they have. Follow up on that? Any follow up?
I'm wondering what you think of the CTV divestiture, and if you like the company now more than they're deleveraging as a result of that.
Yeah, I don't talk about a specific name that we own and that type of thing, but we have to disclose it because it becomes higher than when it goes above 20%, or I guess over 10% we have to. But we like the management of the company, and we think we've bought it at a pretty good price, and we take the long-term view. But we never do anything hostile, though. We think that's a plus long-term. So companies want to do business with us. So if you have a problem, we had a situation where we got 30% in 2008, early 2009. It's public, so I can tell you. H&R REIT building a big building in Calgary, the Bow it's called. It's a massive construction, and they had a little bit of a problem in terms of raising money. They came to us, and we owned about 35% of the company, I think, at that time. Significant, but we liked the management of the company. We very much liked them, and we supported them, and they didn't feel worried that they sold us 35% of the company. As it happened, within a year, they were able to buy it. Worked out very good for us. Worked out well for them, and so we think it's good to be friendly and not hostile. So sometimes we'll miss opportunity, but we're very friendly in our deal, so that the management runs the company. Thank you.
Over the course of your career, access to information has improved a lot. So how much more difficult is it to find value today than it would have been 25 years ago as a result of that?
How much more difficult?
Yeah, just finding value picks as a result of there being increased access to information.
Oh, I see. Yeah, that's a good point. Information, internet, right? Ben Graham had a lovely piece on this. Lots more information, right? Doesn't mean a thing, because human nature hasn't changed. So how could you get, at the end of 2008, early 2009, the S&P, Standard & Poor's index, 500 index, was like 675. 1 year later, it was almost 100% above. You could buy companies at 3 and 4 times earnings in 2008, 2009. Really good companies, financially sound. So you got lots of information, and that information is in the market, but the decision that you make with the information is still as inefficient as it always was. Because as human beings, we get really excited or we get depressed. And we vacillate between the two. And the market's a great example of that. It goes up and down. So Ben Graham had this lovely observation. He says, companies make money, pay out some dividends, and the book value continues to increase. That's a investment. That's something that that's an investment condition of a company. Most companies, some will get into problem, but most companies are making money, paying some dividends, increasing book value. The speculative element of businesses is stock prices. They just go up and down with no relationship, I emphasize, after 35 years, no relationship to what's happening in a company. So years ago, we bought Seagrams, the whiskey guys. We bought them below cash per share. So say they had $70 of cash per share, cash. They had sold an oil and gas company. You could buy them at 65. You get all their plants, you get their inventories, booze, all for free. And the worry at the time, so you say, why did that happen? Well, people on the street felt that the Seagrams, would waste away that $65 in cash that they had in cash. Now, as it happened, 25 years later they did that, but not at the time. They did that years later, but $65. So stock doubled and trebled over time. So you have this. The information's freely available, right? Now you might, for example, Facebook. You guys are all into Facebook, right? I got to tell you this. I think 2 weeks ago was the first time I identified what Facebook was all about. My kids are all in it, but I said, I told my son, show me what this Facebook does. But it's worth $50 billion, right? $50 billion. And they say, and it might be more, it's not a public company, and it's got revenues, they haven't made it public, but $5, $6, $10 billion. So you're paying a ton of money already for something that's got, $5 to $10 billion of revenue. But everybody, Goldman wanted to raise money, and they did it like that. And they couldn't raise it in the United States for some technical reasons, so they raised it in other parts of the world. They got $1 billion. But look what you're getting, right? So the information's freely available. I'm no expert on Facebook, but I know that it's 50 billion. And why would you ever? So you get emotion, and you get greed, and you think you can make money in the short term, and that has always been the case. Markets, and by the way, that's all markets, right? So today, commodities. If you look at commodities, right? Copper, gold, any commodity you want to see, almost without exception. You see it in what we call a parabolic curve, right? Goes like that. Just like silver might have gone in 1980, and when the Hunt brothers were trying to corner it, and you never know how high it's going to go, but then sometime it stops and it comes down significantly. So today, everyone thinks China is expanding, India is expanding. There's only so much supply of commodities, these prices are going up. But the very act of these prices going up, there's a whole ton of inventorying that's taking place. I was reading about the Chinese cotton farmer who's decided to hold back cotton so that he can get higher prices, right? And this has happened before. It's a market, and they react. When things go up, they want to keep it so that they can get higher prices. And then when it changes, they're all coming in and hitting the market. Markets are like that. They're very emotional, all markets. And so the information component is much higher, much easier. You can get into any company all over the world today. Go into the internet, check the company. They usually have a presentation. Used to be you'd have to get the annual report. It would take weeks to get the annual report when I first began. But now you just go into the internet, you get everything. But the decision that you make on it still is inefficient. So all that means is it's a great time of opportunity for you all individually, because when you've got bigger sums of money, it's tough to move it in and move it out. But you can be very selective and buy it at very good prices. So the opportunity is as great as it always has been.
All right, thank you.
You're welcome. Next question, sorry.
Hi, a question for career advice. What are some people skills that new security analysts forget when they take on their first job? Like, for example, are there any specific manners that you might find as a pet peeve?
What my first job was?
No, like, are there any certain people skills that a fresh graduate in the security analyst business they forget, and that you might find as a pet peeve?
What job you could get as a first job?
No,
Sorry,
I'm just wondering, like when people take on their first job
Yeah, yeah.
as an analyst, what are some like people skills that you find are neglected that you'd hope that they'd have? Like,
that they might like the job and that type of thing. You're thinking?
like as opposed to technical skills on analyzing value, what
Oh.
are some like you were talking about pride, arrogance, and things like that.
Yeah, yeah.
What are some like other attributes that you tend to?
Oh, I see. Okay. No, that's a good question. So you're saying what other attributes would you like? The biggest, again, I tell you what Ben Graham said, right? And I've been my experience. So do you have to be hugely intelligent? I hate to tell you, no. Do you have to be a really hard worker? Well, if you love the business and you're passionate about it, it's not work, you're going to spend a lot of time. But the key requirement that you need is the courage of your convictions. What does that mean? The stock market's, you're buying something, say at $10, and the stock goes down to 5. Stock's saying you're wrong. You bought it at 10, you think it's worth 20, it's gone down to 5. Will you change your mind, or will you say, I don't care what the stock market's saying, I'll buy more at 5? That's tough to do. If there's one single observation that I have, is that the ability to buy when things go down is very tough for most people. For some, it comes naturally. For us, for example, in our company, it comes naturally. We're looking for it to come down, right? But for people that I've worked with over time, they'll buy something at 10, and if it goes to 5, they'll think they made a mistake, right? So what we do is when we buy something at 10, we'll say, why did we buy it at 10? Why did we like it? 1, 2, 3, 4, 5, 6 reasons, right? Then you say when it goes to 5, you take that piece of paper out and you look at the 6 reasons, and if they're all as valid, right? Maybe there's some temporary problem here and there, but otherwise it's what? Buy some more at 5. That's a very important thing to do, to be able to average down. Most people are not able to do that. That's a skill, I think. Of course you have to be hardworking. All of you are intelligent enough. That's not going to be a problem. The problem is going to be, being single-mindedly value-oriented and being against the crowd, doing something that's different. Because when it goes to 5, there'll be 20 analysts that are telling you it's worth only $5, it's only worth 6, you shouldn't be buying. So can you say, you're wrong, I've done my work, this is what it's worth? That's an important characteristic for success, I think, in the investment business. But otherwise, the ability to get along with people, all of the things that you learn here, all important. But if I had to ask you, if I had to say to you, it's important to get into something that you really love, that you enjoy, right? Now, I lucked out because I work very hard, but I've never considered it work, and never put money ahead of what you like. So when you like something, put money at the back, the money comes behind, right? It always will. I've seen it with all sorts of people. Put it at the back, do what you really enjoy, and it'll come. And go into a company that is a good company, that you can work for long, that you can enjoy, being in the company, learning good. I was very fortunate. Confederation Life was a fabulous company with this guy, John Watson, and he was only 33 years old, and we were 24, and he was our boss. But he had very good values and, just a very good model for us all. There were 8, 9, 10 of us analysts. And that's good for you as a young person to be exposed to. Thanks. Next question.
Actually, I have 2 questions. The first one is, you stress really hard on the importance of margins of safety today, as you did in the presentation in 2007. It's a cornerstone of value investing. However, the investor is really afraid of value trap. Even though you have a margin of safety, will protect your downside, but if you go into value trap, your investment won't, you just stay there for years.
Yes.
You lose the opportunity. How can you avoid the value trap?
That's a very good question, and you're talking about value trap. So we invest with a 3, 4, 5-year perspective, and usually the market can recognize what you think is value in 3 or 4, 5 years. But the single, and sometimes it takes longer, so you have to be patient. But the single biggest determinant for us is management. And there's the management is not as tough as you might think. That's why I gave you these guiding principles that I highlighted. What's that track record? So here's a guy who's had 2 years track record. He's talking about great growth in the next 10 years or 5 years. No track record. If you look at he or she, where they have been for the last 5 years, for the last 5 years here, no track record to speak of, right? So you have to look at track record. The good companies, the good guys, good people who are running the companies have got good track records over time. If they don't buy it. So, for example, in Wells Fargo or Johnson & Johnson, you can see like long periods of a good track record, right? So if you have the wrong person in, tough. They can consciously create a value trap, as you say, or unconsciously, meaning they think they're doing the right thing, but they're killing the value in the company through misallocation of resources and through basically making poor decisions. And so you have to. That's whenever we had a problem, we've made lots of mistakes, which I must remind you. John Templeton said this many a time. He would come in and there'd be a Q&A like this, and he'd say, 1 out of 3 decisions that I have made, and he was among the best investors, 1 out of 3 have been wrong. Meaning I bought something that was I should have waited, or I sold something that I shouldn't have, I switched at the wrong time, whatever. 1 out of 3 decisions that I've made, only 2 out of 3. And he says, that's 66%. 2 out of 3, and you get one of the best track records in the world. So you're going to make mistakes. That just is life. But if you can focus on the people, one of our things is always to look at the people who are running the company. What's that track record? Financial soundness, all of the disclosure, and all you can read, and you can do the math for the financing. But taking time to find out why some company is good and another what the track record of a person who's running the company, very useful for you. And you can do it. You don't have to be a genius. You just have to do a little digging. Sometimes you have to go, if this person worked for 5 years and then he worked 5 years somewhere else, go and find out from somewhere else, which other company, and you can find that out. You just need to do a little more work on it. By the way, another good book, another good guy is Phil Fisher. Phil Fisher has written some fabulous books, Common Stocks and Long-Term Investing. You read it, right?
Yes.
I actually, that reminds me. I don't have that book. Hey, but before I forget, Peter Cundall passed away. Peter Cundall just passed away, a wonderful investor, a great friend of mine. I've known him for a long, long time. He just passed away, I think, a couple weeks ago. But he did write a lovely book called There's Always Something to Do. And I read it, and he asked me to put a little forward in it. And I gave the where you can order it to George. You will really enjoy it because it tells you how he began in the investment business. He had the same questions that you had, and then how he got into Ben Graham and how he said, my goodness, this is the way to go. His initial investments that he made, fabulous reading. So I just thought it's called There's Always Something to Do. And I'll tell you about the investment business, there's always something to do. Up markets, down markets, there's always something that you'll find that you can do. But Phil Fisher, I was just saying to you, I'll give this to George. Reading is a very important thing in the investment business. You got to read, right? And you got to read, and you'll learn a lot just by reading. So I like to make a list of all the good books that I've read, which are useful for the investment business. And I'll give it to George. There's 2 lists here that I give it to young people when they come and see me. But I'll give it to George. And just read Now, you seem to have already read Phil Fisher. Some of you have read, it's good. But Phil Fisher, now, he's a terrific guy. But can we have a next question?
Oh, I have a second question. So I look at your portfolio, and it seems to me it's really wide diversified. You have like $50 billion plus company, and then less than $1 billion. And you have like technology, and then you have healthcare. Like it
Yeah.
seems you find value everywhere, everywhere. Like
Yeah.
we have really limited experience.
So-
How can you find those value companies? Like so much of them.
So what we do is we invest worldwide. Our business is worldwide. So we're in, of course, North America, but we're in China, we're in India, we're in Singapore, we're in the Middle East, right? And these countries all grow significantly, eh? And so if you're in that country, so our business is very simple. Property casualty insurance, so that's totally decentralized. Investments, totally centralized. And so we have a company in Singapore, and we got a terrific guy who runs it, probably one of the best guys I've ever seen. But he runs the property casualty side. He's also good in investments. But that investments is controlled from Toronto, right? But it is invested in Singapore. And there's very fine companies in Singapore. If you're a long-term investor, you could have 8, 9, 10 times growth if you buy it properly, right? So that's what we do. We invest worldwide. And we buy $1 for 50 cents, whatever it is, right? Whatever it is. And you'll see some of the stocks we have, and some of them we've taken a beating on too. So if you follow us on any one situation, you might get hit. But and if we really like something, then we take a bigger position. So we have about, there's about 6 of us. There's 3 of us who work together. How about this one, eh? I worked with Roger Lace was 1 year after me at Western. I worked together, and he came to Confed, where I went. So we worked together since that time, 35 years. And Brian Bradstreet was already there. So I worked with him for 35 years. We're all working together. And there's another 3 guys that we work who have been with us for 20 years. So and they're all value-oriented. So when you work together for such a long time, I mean, most of us were not even married at the time, so we've known each other for a long, long time, and it is easy, to otherwise you get bureaucracy. And investments, you can't get bureaucracy. When you make a decision, you have to be able to put it into practice. You can't have 5 people, what do you think, what do you think, what do you think? I got to tell you, John Templeton had this story. They were managing money for a hospital in New York. Good cause, right? So they take the best guy from here, best guy from here, So 6 of the best money managers in New York said, we're doing this for charity. Let's get together, invest the money, and get the best return, right? So they would never buy a security, stock, unless everyone said, this is a good deal. So you said, okay, we got to buy it, right? So a year or 2 later, they looked at it, and all of these 6 guys had terrific results, but the portfolio was really doing badly. And then it struck him that when you have 6 people, and each, so the only thing that went in was the one that everyone agreed on in terms of consensus, that's never the right way to to invest the money. Because uncertainty is the reason why you get a good price. So if you try to get 6 people to agree, and they're going to say, no, I don't like this, I don't like that, then you only get the stuff that is fully discounted in the marketplace, right? So he said one of the things that he learned was, and I'm like this too, is that you have to have one person make the decision. So when we have 6 people, there's money that one guy has here, so we have pools of money that each one has. So he doesn't have to say Sam Mitchell. We have Sam Mitchell. He can invest whatever he wants in that pool of money. Roger Lace can invest whatever he wants in that money. But once he makes that investment, then the rest of us look and see what he's made, and then we say, oh my God, that's a very good investment. We'll put some more money, and then we keep adding it up. And then if we get, for us, like 400 million is a big investment in one name. So to get to 400 million, some ones bought it, and then others have jumped on, and then, but it's all individual individual decision making, not group decision making. Group decision making doesn't work in investments.
Hi, thank you so much for coming to speak with us this evening. My question is, I was reading that in 2001, Fairfax received a lot of criticism for specific takeovers.
Yeah.
And I was wondering, during those times, how do you deal with that criticism, and does it ever affect your decision making going forward?
No, that's a very good question again. So in 1999 and 2000, 1998, 99, we bought two big companies in the United States. And it took forever to turn them around. They were turnarounds, took forever to turn them around. So we thought we'd turn them around in 2 or 3 years, right? We have a combined ratio that we have to, it's a metric that you look at for the property casualty business. And we were focused on getting that done. Took us more like 5 and 6 years. So Crum & Foster was a company we bought in 98. And I remember our shareholders, quite a few in the United States, one lady said to me, Prem, you made 3 years after 98, so about 2001, exactly 2001, 2002. She said, you made a mistake, right? Why don't you just admit you made a mistake? You bought a company, you bought a lot of good companies, she said, but this one was a mistake. And I said, you may be right, but it's like a baseball game. There's 9 innings. After the 3rd innings, you haven't lost the game, or 4th innings, right? So here's what happened in that company today, right? Crum & Foster. We paid $680 million for that. And it's an example of long-term, focusing on the long term. We paid $680 million in 1998. By the end of 2010, we had dividends of $1.5 billion, and the company still has, in the company, $1.2 billion of statutory capital, right? So 680, 1.2, after we've taken 1.5 billion. So, but it took us a long time. It took us forever to turn it around. But we just focused on it, worked hard. People who turned it around were outstanding. We had some really good people who worked in that company. And so we just took a longer time. And so our view has always been in our company, we don't give any guidance, no guidance. Business is a long-term deal. Who knows what will happen in 3 months or 6 months or a year? So we say, if you're a shareholder of us, you're thinking long-term, because we really don't know how to do well in 3 months or 6 months. So our company is not run in a 1-year basis or 2-year basis, right? So we take it over long term. Over the long term, we have compounded. We started with a book value per share of $1.50 US, $1.50 US, or $2 Canadian. And our book value today is about, at the end of September, was $400. So that's a compound growth rate of 25%. But there were many time periods during that time period where a compound rate would have been 3 or 4%. But long term, put it all together, it's a pretty good rate. Thank you.
Hey, Prem.
Yes.
I just have a quick question on your views on talent and compensation. So let's say Fairfax wanted to hire some portfolio managers and you had to assess a few candidates. How do you determine the intrinsic value of people, and what is a fair price to pay for them?
And how do you compensate them?
Yeah.
Yeah, that's a very good question. So, to get the right person, you cannot pay too much. The difference between getting the right person, you'd be happy to hear that, right? But that's been my experience. You get all this thing about corporate governance, and you're not, salaries are too high. But a good president, CEO of a company, can do wonders. Now, I say this, I'm a controlling shareholder of Fairfax. So what I did this in 2000. I fixed my salary at 600,000 Canadian, no bonus, no shares, nothing, because I said I'm a controlling shareholder. So the only difference between you, a shareholder, and me is the $600,000 Canadian that I get. Nothing else, right? I did say to our shareholders with a smile that I travel a little better than you because we do have a plane. But but seriously, I fixed my compensation, so it doesn't affect me, right? But for our president, Andy Bernard, we hired Andy Bernard when we had a little company called Scandia Re. And it was writing 250 million US reinsurance, right? 350. And he's working for Transatlantic Re, second largest company in the broker reinsurance market, and he's number 2. And so when I first met him, I found out he was the guy I should hire. He's a good guy. So he said, Prem, at dinner, you must be kidding, right? You're not expecting me to leave this company and come. This is like it's no longer in business. And so I did tell him, I said, the fellow who's running that company, he's young. He's 1 year old. Andy was 40 and this guy was 41, 42. I said, he's going to be running it for a long time. He's a good guy, running it for a long time. You're not going to be, you come with us, you can run the company and you can build the company. Andy, that's simple hire. Andy took the company from 150 million in business, Scandia Re, and today we are writing about $2.5 billion worldwide, right? Unbelievable performance, and the book value growth of Odyssey Re is second to none in the reinsurance business. So management can have a huge impact, massive impact. Now, Andy's a very good guy and he's reasonably compensated. You can check it out. But I have learned that for the right guy, you can't pay enough. You really can't pay enough. But again, good track record. And then, of course, in our case, now see, he had a 15-year track record with us, right? 95 to 2010. And now we've taken him, and he's got another fellow, Brian Young. He's going to take over. He's only in his 40s. But Andy now is in charge of all our reinsurance business. Got a terrific track record. Wasn't difficult to do because he's got a wonderful track record. We put him in charge of all our business. But sometimes, some people take a lot of money, and you see it. I won't mention names in companies, but you have to dig deeper. Too much is not good, but I like the fact that if you're a controlling shareholder, then you should put yourself in a different position. See, so what happens is this guy's the president. I give him a big raise. Then it comes to me, and he's reporting to me, and my salary goes up, right? And that's what you should not get into. And so I just got rid of that. But that allows me to make sure that he gets paid whatever he deserves, and he gets paid whatever he deserves. And but compensation is important, but it's second. In our company, it's the culture. It's our team culture that's very, very much a plus.
Yeah, great, thank you.
Yeah, thank you. You're very welcome. Next question.
Hi, Prem. I just want to revisit your investments, actually. I noticed that your segments were 30% health, 16% technology, which was interesting. And I was kind of just wondering, did you have a mentality behind how the allocation worked out? Like, were you analyzing trends or try to make it work that way? Or did it just kind of happen? And also, some other stocks that interested me were Walmart and RIM, and hoping you can speak to that.
So if we have an investment that has some tough times, then what do we do in that case?
Yes, that's it, yeah.
Is that the thinking? Mm-hmm. Yeah, so we've, so one advantage we have as investors is we're in business, right? So because we're in business, like we're running businesses, right? Mm-hmm. So that helps you when you're investing in a company. So this, you need more financing. This guy needs some help in some area, and so we help them with that. We'll provide them with that in a consultative manner, not in a hostile manner at all. And especially when they need financing, quite often we've done it ourselves. Or we'll take a big lead position. We'll say we'll take 30% of it or 40%. So it's easy to get the financing done when someone is putting in 30, 40%. So we are supportive like that. It's all in a supportive way. But in spite of all that, sometimes when a company gets into problems, you can't do anything to save it, and it's just a fact of life. But someone said, Ben Graham also said, if you look at companies, rarely does a company fail. Like it'll be going down, 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 and then something will happen. Someone will come and buy it. Private equity may take it over. Someone will put some money in. Something will happen to turn it around. Just look at the history of companies, right? And very, very few just go, that's rank bad management, but they just go, bang, gone. There's always something you can do, right? Next question.
Thank you.
You're welcome.
How's it going? Sorry, my voice is going. But you mentioned there's a lot of leverage in the system, and that's partially a result of financial innovation, more leverage bets.
Yeah.
So what's your take on trying to regulate financial innovation and banks, and would you own any Wall Street banks?
That's, so banks are, when you have the leverage in a bank, right?
And it's
15,
not
20, 30.
Not just leverage in the bank, but the leverage in the products that they
Sorry, give me again?
Not just the leverage in the banks, but the leverage in the products, like the securitized products, the leverage bets on these.
Okay, like, what do you mean, like a...
Like, for example, so like you get like collateral, like CDOs and stuff, allow you to make leverage bets on housing, which like create...
Yeah, no, that I think is fine. Like, like in the marketplace, it's buyer beware, right? If you buy something, always figure out what it is that you're buying. You have to know it. No one's going to help you. Caveat emptor, you heard that expression? Like you have to watch what you buy. You got to do your work. But on banks, if I can just go a little, banks, they've got huge leverage. So the guys running banks, Brazil never had any problems, And you know what they do? If you are running a bank, you're the CEO of a bank, and you make sure, and you are responsible for the bank going bankrupt, they will take every cent of your salary, your net worth, will all be taken away for 3, 4, 5 years. And not, you can't move it to your wife and all. They take your wife, your children, everything. Right? It's a hell of an idea, right? Doesn't that focus the mind? It's like that engineer, or it's like the designer going under that Roman bridge. Right? You go and get a bank, a company that you make a bank go bankrupt, and it's all over for you. You need something like that for these big banks so that they don't take risk, because they got so much of money, they can take a ton of risk. They're a little worried from 2008, but give them a little time, they'll forget about it. And so, that would be good. But a leverage product, I feel badly for people who bought it, but you got rating agencies, right? So you got rating, give you a AAA rating. And that's another thing, by the way. Just because a Standard & Poor's or Moody's or whoever the rating agency is puts a AAA rating doesn't mean you put your money in there without checking the underlying credit metrics. You've got to do your own work. You can't say, oh, this is rated AAA, and so I'm not going to bother to do any work. Many, many people did that. In these, like you said, in these collateralized bonds and asset-backed bonds, right? Single statistic, there were thousands of structures which were rated AAA, which had no organization to them, and here you had less than 10 companies that were AAA. Like how did that make any sense? When these structures went into problems, you couldn't get any information, there was no one you could phone, they just disappeared, right? But companies have a CFO, they have a management team, but there's only 10 of them that have a AAA rating, and tons of, and like hundreds of billions of dollars in these structures that were rated AAA. Big, big problem in the past, and we sort of saw it, and we avoided it totally. And the people who bought these were saying, AAA, why do I want to buy a US Treasury, which is AAA? Why don't I buy this and get 15, 20, 30 basis points more? Reaching for yield can be very, very difficult. Yes?
So you spoke about how Fairfax feels it's very important to invest in communities.
Yeah.
But traditionally that hasn't really been reflected in company stock prices. So I'm curious if you think that given all of the attention that's being paid to corporate social responsibility initiatives now, do you think that's going to change? Do you think investors are going to start putting a value on those types of programs?
Yeah, we think it's a good thing to do, but I remind, we have a little phrase that we use, which is doing good by doing well. Never forget you got to do well first so that you have the ability to put money back into the communities. So some companies, some maybe, people who are associated, think you have to do good first. You can't do good unless in a free enterprise system, you have to do well. You have to focus and make sure you're profitable, and then you can take some of your profits and invest, as opposed to donate, invest in the community institutions. But there's many company that's gone the other way, and of course that doesn't work for anybody, including the institution that is being helped. But otherwise, I do think that's the right, that's how free enterprise works, right? You have a business that's successful, and you get the hospitals that benefit, the universities, particularly in the United States you see this, any hospital, any university's always got someone, company or individual, who's put big money behind it. And so I think it's a good thing. Yeah, some people say it shouldn't be a company deal. It should be individuals who do it. And I'd like to think of it as both. Companies invest because we're in all sorts of communities, right? And I see the impact on the people who work in our company because they volunteer time. They'll go to the hospital, they go to university, they go to help the people who are disadvantaged for whatever reason. And there's a big plus that people who work in our company get from that work. And so we just think it's the right thing to do.
Thanks.
You're welcome.
Okay, the last question from me, Prem.
The professor, my goodness.
What is the most important thing you learned in investing and in life over the last 30 years?
What is the
most important thing you learned in life and investing for the last 30 years?
Well, for me, George, for me, it's always been, and I mentioned this to you, I learned this from Templeton, it's your relationship. You're fortunate to get all the things in this life. So for me, it's always been a spiritual relationship, first and foremost. And when that lady asked me, how did you handle all these difficult times? I said, when you have that faith, when you have a strong faith, then anything is possible. Secondly, George, for me, is family. I'm from a culture where family is very important. Not only my immediate family, which is my wife and my children. I'm married for 38 years, but also my brothers and sisters, and so family is very important. And then that's why I have this. That's why we have this in our guiding principles. We say, you don't want to. So you make a lot of money and you get, I'm just using it. I know, in spite of all this can happen. But you get divorced, or your children don't do well, or that, and it can happen in spite of a focus, right? It could happen for a variety of reasons. But if you put this, if you put this in your head that you don't really want to succeed at that on that basis, you can have likely it'll work out for you. Certainly worked out for me. And so I'm very grateful, George. I just think that I'm blessed in a huge way in everything that I've done. Many a time, we'll be wanting to go like this, and for some reason it'll stop. We can't go, and then we'll turn and go this way, and then we look back a few years later, and my God, if we had gone that way, we'd have gotten right into the ditch, and we couldn't do it. We wanted to do it, but we couldn't do it. Now, you might say good fortune. I say blessings. But thank you all for listening. It's very nice to be here.